Got my big girl earrings on for you today. We're going to talk about investing. Before we get into it, I just want to say I'm not a financial advisor. Please do your due diligence before you start investing or acting upon any of the information in this video. I'm just trying to make a subject that's generally quite inaccessible, easier for more people like you to understand. Okay, so what is investing? Generally, investing is where your money grows over time. And new investors, like myself, generally do this on the stock market where you buy and sell shares in many different companies. A share is essentially a small part of that company that you own when you buy that share. You can also buy and sell using funds, and funds are usually a collection or a pool of many different companies in one pot. For example, this would be like buying a tiny part of Dior versus buying loads of tiny different parts of Chanel, Dior, Prada, Primark. For the longest time, there's this perception that investing is reserved for the rich, people who have loads of money, really wealthy, that sort of thing. And for quite a long time, I thought this too. But that really isn't the case. You can start investing, and I did myself, with just £20. And taking that first step is all you really need. I genuinely feel that this shouldn't be slept on. They don't teach this anywhere in school. And for me, beginning to invest was the start of me truly understanding how to build wealth. And we're all trying to do that out here, you know? So it's worth mentioning the risks. So investments are a little bit different to money that you have in your bank account or your savings account, which are generally protected to a certain amount. Whereas with investing, your investment may go up, but equally it may go down and you may lose money, and that is not protected. Risk is such a big factor in investments, and this is often the thing that puts people off. So how much can I make from investing, did I hear you ask? Well, it's impossible to say what your return will be on your investment. Like I covered before, your investment can go up as well as go down. However, what we can look at is historic market trends. We can get a sense of what this looks like by looking at the performance of very long-standing stock markets such as the FTSE 100 that we have in the UK. The FTSE 100's average return from 1983 to 2019 was on average 7.75% a year. And when you look into this, it's not smooth sailing, it does go up and down, but over the course of time it levels out, and on average that's 7.75% of growth per year. And if you compare that to what the average savings account is giving you, the most you'll probably get is around 1%. Most people are on a lower rate, like 0.1%. It kind of makes you go, Hi guys, editing Vashi here. I just want to caveat here something really important. I'm not suggesting you start investing instead of saving. In fact, please have an emergency fund in place and a savings account with, set amount set aside to make you feel secure and comfortable. Any credit card debt, Klarna, all of that good stuff, please make sure that's paid off before you start buying Tesla stocks. You don't want to get into more debt by trying to grow your money. That's not what we're trying to do. During the peak of the panoramic, the market did significantly crash. But if you look at it now, it's actually bounced back again to pre-panoramic levels. Okay, so how much should you invest? There's no set figure for this again, and like I said before, this isn't reserved for the wealthy. For me, I started with £20, but some platforms you can start with £1, £10, £25, whatever makes you feel comfortable. I suggest if you are starting, start very low. Don't go in with thousands and thousands of pounds. You don't need to. And it doesn't really matter how much you start with, as long as you start. And the sooner you start, the more you'll benefit. Why, you ask? Well, that's because of something magical called compound interest. Compound interest. So think of it as a snowball rolling down a hill. The more it rolls down this hill, the larger it's going to get. So the sooner you start, the more you will benefit. This is so good. Imagine your money making money, making money, making money. That's how the rich get rich. So you've decided you want to invest, but how do you actually do it? Gone are the days when you had to go to someone suited and booted. You can actually do it yourself. There are so many apps out there you can choose from, and a lot of these also have features where you can simulate what's actually happening in the market real time, but use fake funds to get yourself comfortable with the highs and the lows and how things actually work. I recommend you do your research and see what works for you. Some of these platforms will have fees and others will be fee-free. For me personally, I use Trading 212, and I'm sure you've heard of it, and I find it pretty easy to use. I do have a link in my description bar if you do want to use it. It's a link personal to me, so you will get a few shares once you sign up, and so will I. Not sponsored at all, and yeah, no pressure. You don't have to use that link if you don't want to. Okay, so you've decided you want to invest and you know what platform you want to do it on. The next question you're asking is, do I invest in companies on their own, so shares, or do I invest in funds? And what you choose is really up to you and your own risk appetite. And what that means is how much you're willing to risk. In general, shares tend to be a little bit more risky because you're putting all of your eggs in one basket, whereas funds tends to diversify your risk. And what this means is that your risk is leveled out. And this is because funds contain a mix of loads of different companies. So naturally, some will do well and some less so. And in general, funds usually mirror the market. And as we've covered before, the market is generally on an upward trajectory. So funds are a pretty good indication that your money will grow over time as the market does. So for me, the biggest thing about my investing journey is just becoming comfortable with the ups and downs. Believe me, when I put that first £20 in, I saw it go down to £15. I was like, oh my gosh, imagine if that was £2,000. But don't worry, over time you learn to get used to those ups and downs, and things will go down, but they will also go up. So you just need to get comfortable and not get too emotional about it. Just to put your money in, don't move it around too much, and just let it grow, and over time it will likely grow. And I think the best thing that's happened to me from beginning to invest is that it's changed my mindset of money in general. Before, I'd be like, okay, I need that thing, I need to find X amount of money to buy this thing. But now my mindset has changed into, okay, I need that thing, so how much money do I need to invest to make that money to get me that thing? And for me, that shift in my mindset has absolutely changed my life and the way I spend and the way I look at money. And this is genuinely how the rich stay rich. They don't buy things outright. They think about investing and making more money to then buy an asset that makes them more money. So this was a really high level introduction of investing in the way I understand it, and I genuinely feel that it's something that we all can do, and hopefully I've helped you feel a little bit more comfortable about it, but please do your research. I hope we get wealthy together.